Divergence is one of the most powerful technical analysis styles of trading, but is oftentimes misused or underused because it's very difficult to read in many circumstances. In technical analysis, divergence is considered either positive or negative, both of which are signals of potential major shifts in the direction of price. So positive divergence is when price of a security makes a new low while the indicator starts to climb upwards. In this case, the indicator is the relative strength index, or the RSI. Negative divergence happens when the price of a security makes a new high, but the indicator fails to do the same and instead closes lower than the previous high. For the MacDiver, we're using the moving average convergence divergence momentum oscillator, or the MACD oscillator. There's an easy calculation for learning and understanding how the MACD oscillator works, but we're looking at the short-term momentum compared to long-term momentum to help determine the future direction of whatever the MACD is applied to, whatever the market is, or the asset or the stock or the future or Forex. So when you notice that the slope between the swing high of price and the swing high of the MACD oscillator is different, then we have a divergent condition, or the swing lows. Then we have a divergent condition, which is a very powerful trading condition. To better illustrate this, we've got a rudimentary chart here with price and the MACD oscillator below. What we're looking at here is noticing that we have a similar magnitude of change over the last X bars. So we won't see that price and momentum have changed directions at any point along that line. They will both be running the same direction. This would be most common to how you would see the markets running. Momentum and price will usually run together. When they do not run together is when price and momentum get out of sync. You'll notice the magnitude of change is a little bit different. And now, somewhere along that change, you will notice that we have a divergent condition. Well, price is still setting new lows, new lower lows, but the oscillator is setting higher lows. So if you look at a trading chart, on first glance, you may find it very difficult to pick out divergent conditions. On a quick glance, you'll notice that you see price and momentum in agreement with each other. But there is a divergent condition, and look what happens to price when that divergent condition is identified. One of the reasons divergent is so very powerful is knowing that when momentum turns before price, price will typically follow. Many people believe there's no such thing as a leading indicator. But when momentum turns and turns before price turns, then that is a very powerful leading indicator. Price will almost always follow momentum. So the trick is to learn to identify divergent conditions. You can either train your eye to do it, or you can attempt to use many of the divergent signal generators or indicators that are on the markets, and you may see something like this where you have a lot of lines that draw backwards and usually will be 3 to 4 bars after the current bar. Our MacDiver indicator prints on the current bar, makes it very easy to see and understand where divergent conditions exist. You'll notice what happens to price immediately following a divergent condition. And again, we do not repaint. These indicators show up on the open of the current bar so that you can make an immediate decision. This is an excellent indicator to use on minute charts, 5-minute charts, 15-minute charts, tick charts, Renko charts, and more. The MacDiver is an extremely powerful indicator that you can use for trading pullbacks or retracements from a trend, scaling into or out of a trend, developing an entirely new trading system around it, or simply by adding confluence to your own current trading system.